right. Hallelujah. How are you guys doing? This is Leo. Welcome back to Star Invest. Today we're gonna talk about next five companies of the 15 companies I really love to buy and hold for 2026 and beyond. Your time is important and I'm not gonna hold you hostage. Let's dive right in. The next company I want to talk about is Form Factor. Form Factor is headquartered in Livermore, California, specifically at 7005 South Front Road. The company has shown fluctuating but generally resilient revenue growth over the past 5 years, with fiscal 2025 revenues reaching approximately 785 million, a mere 2.8% increase from 2024 following a revenue decline in 2023. But however, why do I love this company so much? Let's dive in more. The revenue growth has not been the best. Fiscal 2021 revenue growth was only 10.97%. 2022 revenue growth was 2.82%. 2023 revenue growth was actually down 11.34%. Revenue 2024 growth was up 15.16%. And for this year, whole year 2025 was up only 2.8% from 2024. But why do I like it so much? Let's dive right in. But why do I like this company so much? Let's dive right in. So in order to understand this company, why despite the past performance, the poor performance of its past, I still love the company so much going forward because Form Factor specializes in essential test and measurement solutions for the semiconductor industry, enabling chip manufacturers to verify device performance, improve yield, and reduce cost. They provide products like probe cards, analytical probe stations, and thermal subsystems used throughout the entire chip life cycle. From research and development to high volume manufacturing of integrated circuits. So it is highly related, and the supportive infrastructure play for anything AI chip related and data center interconnectivity related. Let's dive right in. So here we are looking at the next slide. Let me pull up the slide here. All right, Form Factor is considered a strong buy stock in 2026 due to its leading position in semiconductor test and measurements. Driven by surging AI-related demand, SANC ranked number one strong buy. SANC is a company which is more into momentum stocks, so they don't necessarily look at the fundamental of the company. So whether the company is doing well or not, or trending, they only look at the momentum of the stock movement more. And positive earnings estimate revisions. The company benefits from high performance computing, advanced packaging, and strong revenue growth. Why Form Factor is strong investment opportunity, AI and advanced packaging growth. Form Factor is a crucial supplier to the semiconductor industry, benefiting from the increased complexity of chips, AI logic memory, which requires more testing. The space between chips and the space between the memory, all the space have to be very accurate. They are nano nmm away from each other, so they have to be very accurate. Strong financial outlooks and revisions. For 2026, analysts have significantly raised earning estimate, projecting a 21.5% year-over-year change in earnings to $1.58 per share. So imagine if it continues to grow into 2026, I believe it can make at least $2 to $2.50 per share, and you give it a very high PE of 80, I would say, because of the huge fast growth going forward. 80 times 2 is like $160 per share. So next year, 2027, most likely $160 per share. The company has reported Q4 2025 revenue beating expectations and providing positive forward guidance. And then it has also solid balance sheet and cash flow. The company has demonstrated better than average annualized cash flow growth, which was 24.6% over the last 3 to 5 years compared to industry peers. So the cash flow is very important. If the company want to expand their productivity and operation, they need cash to fund the expansion and ongoing R&D as well. If they want to continue to be the leader in the industry, without a good amount of cash flow per year, a lot of companies have to go back to the open stock markets for secondary offering, which means dilution for the existing shareholders, which is not the best thing to do for existing shareholders. Or the company has to apply for business loan, which is also not ideal if the company already has a lot of debt, which is not the case for Form Factor. Industry leadership. Form Factor is a leading provider of essential test and measurement technologies that cover the full integrated circuit life cycle. Okay, next we dive right into is Form Factor seeing expanding profit margin. So not just cash flow, how about profit margin? Let's dive right in. Yes, Form Factor is experiencing significant expansion in its profit margin as of Q4 2025 earnings report. The company has demonstrated a strong, sustained improvement in gross margins driven by operational efficiency, structural changes, and high demand for their testing solutions in AI-driven high bandwidth memory and advanced packaging. Now, within my 15 company to buy and hold for 2026 and beyond, there is another company that makes chips. So we will talk about that. And so wherever they make make memories, not chips. Whenever they make memories or any chips, they have to send their memories or chips to Form Factor for testing and see if all the specs are correct. So key findings on Form Factor's margin expansion. Significant recent improvement in Q4 FY 2025 Form Factor's non-GAAP GAAP, generally accepted accounting principles. Gross margin climbed to 43.9%, a 290 base point improvement from the 41% in Q3, which is excellent. Structural progress since Q2 2025, the non-GAAP gross margin has improved by 540 basis points, with roughly 2/3 of its increase attributed to structural operational improvements, such as better use, faster cycle times, and workforce redeployment, which is wonderful. Positive guidance. Management expects further margin expansion into Q1 FY 2026, which is excellent because management is in the driver's seat and they see continued improvement and margin expansion, which is wonderful. Targeting a non-GAAP gross margin of 45% plus or minus 150 basis point improvement. Long-term targets, the company is on track towards a target model of 47% gross margin as they ramp up new capacity in their Farmers Branch facility. So every dollar they spend in keeping up with the operation, they keep 47 cents, which is wonderful. Because if we are talking about company who are selling cars, for each car that they sell, their profit margin is only 10 to 15% most of the time. But this is 40% gross margin, not net profit margin. But we will dive in right more. Factors impacting margins: drivers, high bandwidth memory, HBM3E/HBM4, and AI-related test intensity are driving demand for their probe cards. Headwinds: despite the growth, the company is absorbing an estimated 200 basis point drag on gross margin from tariffs, which is understandable, and not just this business. If you are talking about Lululemon, if you are talking about Nike, if you are talking about any other company with either shipment to China for sales or raw materials shipping from China to United States, either way, we are seeing tariffs for those imports and export. Margin expansion may moderate if demand softens, which I do not foresee for the next couple of years at least, as the recent gains were partly assisted by higher volume. All right, and then next, so we talk about profit margins, and let's dive right into back into cash flow again. Let's see if it is a nice continuation into the future. Yes, Form Factor is seeing significant improvement in its cash flow from operations driven by record revenues and improved gross margins in late 2025. Recent cash flow performance: Q4 2025 results, the company generated $46 million in GAAP net cash from operating activities in the fourth quarters of 2025. Sequential growth: this figure represents a substantial increase from the $27 million in operating cash flow reported in Q3, which is wonderful. From Q3, $27 million to Q4, $46 million. This is a huge 70% plus, which is amazing. Free cash flow also increased to $34.7 million in Q4 2025, up from $19.7 million in the previous quarter, which is exceptional, almost 85% increase. Wow. Drivers of improvement: high bandwidth memory, HBM demand. Increased demand for AI-linked chip testing, specifically in HBM and non-HBM DRAM, direct random access memory. Applications: DDR4 and DDR5, which some of us may find them in some of our computers or laptops, has boosted revenue and cash flow. Operational efficiency: structural improvement including better yields and faster cycle times, contribute to 540 basis points of non-GAAP gross margin improvement in the second half of 2025. Record results: the company reported record revenue on both a quarterly and annualized basis for 2025, which is wonderful. And what is the profit margins again for Form Factor? Non-GAAP gross profit margin here, 40.8% for the full year 2025, with a strong improvement to 43.9% in Q4 2025. Gross margin was 39.3% for the full year. If you remember, net profit margin, this is the one we want to dive in right in more. The net profit margin was approximately 6.93% as of late 2025, with a net income of $54.5 million for the full fiscal year 2025, and I can expect solidly that the company will see this profit margin double in 2026, double, with higher volume, higher demand, better economic of scales, and the law of large number. Per unit cost will go down substantially. It's like the early day of well, let get Tesla as an example of those. It's easier for you to understand. When the company was small and when the manufacturing facility was small, in order to produce 10,000 cars per year, the per unit cost could be 60, 70%, 80% of the MSRP of the car. But when you get to a much larger economic of scales, you are manufacturing 1 million car per year, because you already have those R&D in place, you already have the manufacturing facilities and all the machine lineup, and due to the learning from previous small batch manufacturing, now you implement to larger batch manufacturing process. You have already streamlined a lot of different aspects of the manufacturing stages. So in that regard, you probably be better now managing the source of raw material and the timing to apply each material into the stage of manufacturing of the vehicle. So in that regard, you see higher profit margin and lower per unit cost as economic of scale improve. So what I'm trying to say is next year, 2026, their net profit margin can surely go up substantially. And trends and outlook. Improved initiative, Form Factor achieved a 540 base point improvement in non-GAAP gross margin in the second half of 2025 compared to the first half, driven by structural operational changes. See, so they improved the structural operation, meaning how they apply raw material, the timing of different stages of the manufacturing or the testing processes. So they improve upon those and reduce cost. Target model, the company is aiming for a long-term non-GAAP growth margin of approximately 47%. Q1 2026 guidance, management projects a further expansion into 45% non-GAAP growth margin, which we have just talked about. Headwinds, of course there are headwinds, but tariffs, you and I already know. It's not something new. So whatever the price targets from analysts are, and from me, are already including this projection of the effect of tariffs. Last but not least, let's take a look at if Form Factor has a momentum, has the growth momentum. Give me 1 second. And then we can be starting again soon. 3, 2, 1. Okay, let's dive right into Form Factor. Does the graph of Form Factor looks like they have good momentum now? Last year, April, the dip in April, $22, $23 per share. Now it's already 4x, 96 today, 95, 96. So 4x already. You may say, oh, this is probably the top. But however, remember, stock reflect the profitability and the trend of profitability and cash flow of the company for the foreseeable future. If the company continue to forecast a good amount of growth for the next few years, the foreseeable future, then its stocks should continue to see improving or higher share prices. Now, let's look at the last 5 years. If you remember previously, Form Factor had negative growth of their revenue from 2022 to 2023, and you can see that the guidance probably was negative from the management, so the share price went down for that year as well. And then remember 2024 to 2020, actually 2024 to 2025 guidance wasn't that good either, and that was before the AI craze. And then because the guidance was not good, so the stock actually also went down, right? And then suddenly the AI craze came, and by April, and it is, showing you that the rest was history. From this to here was history. So what I'm trying to say is, no matter how you look at the past, the future expansion and the growth for the foreseeable future is more important than what the past has been for this company. But then even if you look at the past, it's not all that bad. 2013 it was $4 a share, and now it's already 20x, 21x. So it is not that bad. Even the annualized growth would have been just between 2013 to 2025. Annualized revenue growth, sometimes positive, sometimes negative, could be just 5%. But look, even 5% year-over-year revenue growth from 2013 to 2025, we still see it 20x for its investors. Can you imagine SoFi with 30 to 38% year-over-year growth for the foreseeable future? SoFi in 10 years, can you see SoFi in 10 years would not just 20x, it would be 40x, it would be 50x. If that trend continue, nothing is financial advice. Okay, now we talk about form factor. It does show that it has a continuation of going up. If you can even see it, it has a continuation. However, it has gone up quite substantially. Would the early investor cash out from here? Now let's take a look at why this dip may show us the partial answer. You can see that some investor got in before $20 per share. They saw 80, but they did not sell, expecting the share price to continue to go up. If we take a bird eye view, if you will, but then they expect to continue to go up, so they didn't sell, which is the case now. It's actually higher as 95, but then no one expected it deep down to say 70. See, it's 70. So now you have people here, 82 did not sell, but saw it back down to 70, and now it's go up to 95. Would some of them sell? Probably. I would say those who was in from here, under 30, because some of the fund, once they 2x or 3x, they leave, depending on their strategy. For me, I'm a long-term holder. Unless the company share becomes exceptionally overvalued, such as Palantir and Robinhood. That's why I sold Robinhood at 136 and $131 per share. And now Robinhood today is only 70. See, it was way overvalued. The same thing can be said for Palantir. I sold everything at 160 to 160 line per share. And it was as high as 210. But Palantir to me is only worth $100 per share or lower. And even for $100 per share, Palantir has to grow revenue year over year 40% plus for the next 5 years to justify $100 per share. So we are talking about extraordinary time with a lot of company having gained extraordinarily for their share prices. For example, AppLovin, 20x in 2.5 years. Palantir, 15x for the last 2 years. Robinhood, 12x for the last 2 years. These are extraordinary time. If they becomes overshot to the upside, I of course want to sell some, at least sell some. I'm not that, even though I'm here for long term, but if you, on a short term basis, you are so overvalued. You are supposed to be $100 per share maximum, but then you have $210 per share right up there, 100% much higher than the most optimistic price target already. Then the chance of the company, if it doesn't meet earning expectation, then it will drop like a rocket. Rise like a rocket, drop like a rocket. And that is what Robinhood is doing now, because its most recent earning reports show a miss for their earning. And the company's stock price take a nosedive right away today. And today is what? February 11th, Wednesday. All right, so we are done with form factors. So just be careful, because now it's at all-time high. Some of the early investors may want to cash out a little bit. So it is showing great momentum in the future. Next year or next year, it will be much higher than now. It will be 150 next year, and then 200 next year, if the trend of its revenue growth continue. However, it has just shot up so much for this year. I would just take a wait and see stance for now, and I would not rush in, especially Q1 of any year. Stocks are supposed to be the most volatile. All right, and we are seeing the volatility now. It's going through. So, all right, the next one is an amazing company, Western Midstream Partners. Western Midstream Partners. Let's dive right in. All right, almost starting. 5, 4, 3, 2, 1. All right, guys. So the next one will be Western Midstream Partners. Ticker symbol WES. It's a master limited partnership that acquires, owns, and operates midstream energy assets, primarily gathering, processing, and transporting natural gas, crude oil, and NGLs, alongside handling produced water. Pay attention to water. Operating in major U.S. basins, they provide fee-based services for energy producers, natural gas and liquids, gathering, compressing, treating, and processing natural gas, and transporting condensate and natural gas liquids. Crude oil and water. Gathering, stabilizing, and transporting crude oil, as well as gathering, recycling, treating, and disposing of produced water. Infrastructure operates approximately 14,000 miles of pipelines, plus processing plants and treating facilities mainly in the Delaware, Texas. Business model primarily generates revenue through fee-based contracts, minimizing direct exposure to commodity price volatility. Now, water. What are the use cases for water? What are we talking about since last year? AI and AI data center. Now, this company has just acquired Ares Water Solutions for 1.5 billion. Actually, it's closer to 2 billion now. This is a smaller company which they acquired because they want to expand their service area and their market share in the Delaware Basin area of Texas. Okay, why that area? Why Delaware Basins of Texas? Why Delaware Basins of Texas? Remember that name and the location. Water is absolutely critical to AI data centers. Acting as the primary highly efficient and cost-effective cooling agents for high-density AI servers GPUs that generate immense heat. A single large data center can consume 1 to 5 million gallons of water daily, roughly equivalent to a ton of 10,000 to 50,000 people for evaporative cooling. Without this massive water consumption, AI operation would require far more electricity for air conditioning, impacting sustainability. There you go. Key aspect of water importance for AI data centers: immense cooling needs. Chips like NVIDIA's Blackwell produce far more heat than traditional processors, requiring intensive, constant cooling, often provided by on-site cooling towers. Water-based cooling methods. Data centers utilize wet cooling towers, which evaporate water to remove heat. This method is favored because it is more efficient and less energy intensive than dry cooling, which uses air. Such as our car, we use air, right? Yeah, we don't use water to cool ourselves. But if you have a car, your engine somehow also use coolant, right? Yeah, so high consumption rates. Estimate shows that a small set of AI queries, such as a conversation with a chatbot, can consume roughly 1 bottle of water, about 500 ml already. Half a liter, my gosh. Environmental impacts. Data center water consumption poses significant risks to local water supplies in water-stressed regions. See, roughly 2/3 of new data centers in the US are built in areas with high water stress. Regional constraints. The heavy demand for water has led some municipalities, such as Georgia, to reconsider or restrict new data center development. See how important this is? Okay, this talks about Ares Water Solutions has consistent water year-over-year revenue growth, which is great. It's not going anywhere. All right, and then Western Midstream Partners, WES, complete the acquisitions of Ares Water Solutions in October 2025, which is great, and approximately for $2 billion. And then this will be the area where the company will have a big market share. Oh, you can see. Oh, yeah, you can see it here, but you cannot see it in a bigger picture. Following the acquisitions of Aries Water Solutions, Western Midstream Partners expect 2025 adjusted EBITDA, earning before interest, tax, depreciation, and amortization to reach the high end of 2.35 billion to 2.55 billion, which is great, of their guidance range, with Aries contributing 45 to 50 million in Q4 2025. The acquisition is expected to be accretive to 2026 free cash flow, supported by a 40% year-over-year produced water throughput growth, which is wonderful, 40% high. 2025 outlook: WES anticipated 2025 adjusted EBITDA to be at the high end of the 2.35 billion to 2.55 billion range. Aries contribution: the acquisition of Aries, which closed on October 15, 2025, is projected to add roughly 45 million to 50 million in adjusted EBITDA during the final 2.5 months of 2025. Synergies and growth: the deal aims to capture 40 million in cost synergies, with produced water throughput expected to grow by roughly 40% year-over-year, which is amazing long-term impact. The acquisition adds 790 miles of produced water pipelines and 1,800 Mbpls/d of handling capacity in the Delaware Basin, strengthening long-term cash flow, which is very important if you want to be a major player. And let's see. Now, what is the Delaware Basin? Delaware Basin, part of the larger Permian Basin, is the most prolific oil-producing region in the United States and perhaps the most important oil field in the world today. But we are not into oil, so much into oil as we are interested into AI data center cooling system. Water cooling, reduce the use of electricity, reduce the need for electricity, making AI data center running cost much lower, much easier to run, and less opposition from the local people who are already voicing the possibility that their waters are highly stressed, not enough water supplies to the region. Yes, our production requires large volume of water for drilling too. So not just AI data center, the oil industry also need a lot of water for drilling, hydraulic fracturing, fracking, and enhanced oil recovery techniques like water flooding to push oil to the surface. Water is also used in refineries to process crude oil, with estimates of roughly 1.5 barrels of water used per barrel of crude oil, which is a lot. Key uses of water in oil production: hydraulic fracturing. Millions of gallons of water mixed with sand and chemicals are pumped into wells to crack rock formations and release oil. Enhanced oil recovery: water is injected to reservoirs to maintain pressure and force more oil out, particularly in older wells. During operations, water is used to mix drilling mud, cool engine, and clean equipment. Refining: water is essential in the refining process to produce gasoline and other petroleum products. Water production: oil wells often extract significantly more water than oil, known as produced water, which is often salty, contaminated, and requires treatment or reinjection into the ground. All right, and then let's see what else do we have. Yes, okay. Now here comes our next question. Then there are so many areas with good source to energy supplies in the United States. Of course, Texas is one of the biggest one. But is Delaware Basin a good spot for AI data center? Right? What if more and more newer and newer data center will be built in that region? Let's see if it is a case there. Yes, the Delaware Basin in West Texas, New Mexico, is emerging as a critical location for AI-ready power-intensive data centers, driven by its access to vast, low-cost natural gas and existing high-voltage infrastructure. LandBridge and NRG Energy are developing a potential 1.1 gigawatt data center site in Vives County, Texas, to support high demand computing. Whoa, wow, there you go. New data centers are coming. Key projects, we just talked about that, and expected to be operational by 2029. Energy advantage area is attracting developers due to its location at the Waha gas market hub. Waha. Providing direct access to low-cost, on-site natural gas for power. Major player interest. Chevron is developing its first dedicated data center power plant in the Permian, which includes the Delaware Basin. Significance. These facilities are designed to meet the massive power needs of AI and machine learning, with the LandBridge project aiming to assist with ERCOT grid capacity. Wow. Wow. All right, so let's see if the company has good momentum. Let's take a look. So this would be, let's see, 1 month. Well, the end of January, it dipped to 40 with the market, and now it's going up again. But wow, it's higher and to the right. So there is a momentum, definitely, and particularly if you remember, it just acquired Aris Water Management. So Aris has increased year-over-year revenue growth. So those cash flow and revenue growth will now be part of Western Midstream Partners. So I expect this to go up at a faster clip going forward. And doesn't it show us that there is good amount of momentum going higher highs and higher lows? So higher highs compared to the last one, higher lows compared to the last lows. And yeah, of course, if we look at the previous years when they first began the operation, they have huge loss. You know, you can tell, and the stock reflect that loss that they had, because they are still expanding, they are still making their production ready, and but after the first few years of loss, now they are starting to make money, and they are going up, trending up, and now they just acquire another company to improve their market share, increase their market share in the region. So I expect, you know, going forward, the momentum will only be getting stronger with AI data center coming, the new one to be ready by later this year, and then more next year, more next year. I believe their revenue should be growing nicely. Nothing is financial advice. Right now, I'm trying to just introduce the company to you within a certain time limit. I'm trying to limit myself to 10 minutes per company, but my previous company, I already spent 25 minutes introducing it, and now I am spending close to 50 minutes to introduce this company to you. So looks like I'm running out of time. For the next 3 companies, I will only mention their names here, and then I will try to finish the rest of the of this video tomorrow. So I will be talking about the next 3 companies of this part 2 of 15 companies I am buying for 2026 and beyond series. And so stop. Alright guys, so next is Pure Storage, number 3 company for today, for this video. Pure Storage provides high performance, simple to manage all flash storage arrays, flash array, flash blade, and focused on consolidating Oracle workloads, offering non-disruptive upgrades and reducing TCO via high data reduction. Total compute operation, TCO. Conversely, Oracle offers a comprehensive integrated stack, including its own ZFS storage, H-data database machines, and autonomous database in Oracle Cloud Infrastructure, OCI. Key comparison areas. Performance and architecture. Pure Storage utilize direct flash technology to provide consistent, low latency of flash storage ideal for high transaction Oracle databases. Oracle Exadata is designed to optimize database performance specifically through hardware-software co-design. Simplicity versus integration. Pure Storage emphasizes simplicity, requiring no manual tuning, with Purity OS operating system enabling easy management across environments. Oracle offers full vertical stack with deep integration between database, OS, operating system, and storage, designed for maximum optimization, operational efficiency, and cost. Pure Storage boasts 99.9999% availability, no downtime maintenance, and up to 90% faster cloning refreshes. 90% faster, up to. Oracle highlights the autonomous database and its ability to reduce administrative tasks. Hybrid cloud and flexibility. Pure offers storage as code with APIs, Terraform, and Ansible, allowing for easy integration in hybrid setups. Oracle's approach, particularly OCI, provides a broader cloud infrastructure platform for migrating legacy applications and developing new ones. Now, why people use their cloud services of Pure Storage? Autonomous, everything, workflow, and customer needs, if they need the data temporarily while you and I are browsing the internet, for example, they are scattering our data, and for the immediate time, they need to be put in fresh memory, so easier for them to retrieve the data, easier to put the data in. Everything is autonomously done. And let's see. Pure Storage extensively partners with Amazon Web Services, AWS, to provide integrated storage solutions, but there is no public evidence they are a core technology vendor for Google Cloud. Pure Storage offers Cloud Block Store for AWS and Flash Array for AWS Outposts. Strategic partnership. Pure Storage and AWS have a strategic engagement, including a 3-year investment in container-based storage. Pure Cloud Block Store enables running Pure software on top of AWS infrastructure for high-performance enterprise-grade storage. AWS Outposts and EVS. Pure Storage offers specialized storage solutions for hybrid cloud outposts and VMware migration to AWS Elastic VMware Service. Google Cloud, Alphabet, and Pure Storage. There is no evidence in the provided search result that Google Cloud use Pure Storage, which is fine. They have AWS and also Meta, I believe. Yes, Meta uses Pure Storage for its AI infrastructure, including the AI Research Supercluster, RSC. Pure Storage provides flash-based storage solutions, specifically Flash Array and FlashBlade, to power Meta's high-performance AI training and data analysis needs. Key details about the partnership include AI supercomputing. Pure Storage has been a key partner for Meta's RCS since 2017. Massive scale. The RSC includes hundreds of petabytes. Wow, petabytes. My gosh, I don't even know how many zeros that is now. Of Pure Storage capacity to handle AI training workloads. As described in this blog and files article, Meta is one of the top-tier players in the AI race, and so is Amazon. So having both of them as clients of Pure Storage is absolutely wonderful. Technology collaboration beyond supplying hardware. Meta and Pure Storage collaborate on using direct flash modules, DFM, and QLC technology to improve energy efficiency and storage capacity in metadata centers. Expansion by 2025. Pure Storage secured agreements to be a key storage provider for broader large-scale deployments. Notes this CNBC article. All right, so CNBC also talk about the development. Okay, now there has been some talk in the market talking about is Micron Technology a direct competitor to Pure Storage. Let's see what in reality. Pure Storage and Micron Technology operate in complementary rather than directly competitive roles within the data storage industry. There you go. Pure Storage specializes in enterprise flash storage system and software, while Micron focuses on manufacturing NAND and DRAM, direct random access memory chips. They are increasingly collaborating to provide high-capacity, energy-efficient storage for hyperscale data centers. See? One more friends is better than one more enemy, and they are partnering together and helping each other. That is even better. Wow. Business model focuses on all-flash storage software and hardware, providing turnkey storage solutions for enterprises. Key differentiation utilizes proprietary direct flash modules rather than off-the-shelf SSD, solid-state direct memories, providing high-density, low-power consumption and better performance. Strengths: strong focus on the evergreen architecture, non-disruptive upgrades, and AI-ready data infrastructure. Revenue model: high mix of subscription-based recurring revenue. While Micron Technology business model is a manufacturer of memory and storage technology, DRAM, NAND, and NOR. Key differentiation: high volume advanced NAND manufacturing. These companies are not going to be disrupted by AI. The one that I'm talking about today, they are not going to be disrupted by AI. So as a matter of fact, because I'm running out of time, so let's regroup. The first company we talk about today is FormFactor. They have close relationship with SanDisk and Western Digital. They are also memory related. Second company, Western Midstream Partners. They have just acquired ARIS, ARIS, water management, and they are gonna be the second tier player in the water cooling system. They are the second largest, having the second largest market share in the Delaware Basin area of Texas. Then we are talking about Pure Storage. And the next is actually Alibaba. It's a Chinese behemoth in AI, and not just AI. They have a lot of different channels. They have their online channels, e-commerce channels, on AI data center segment. They have their fintech segment, and they have a lot of different. If you will, it's just like an umbrella of different companies. It's about the same as Google, it's an umbrella, Alphabet is an umbrella of different companies, including Google, Alphabet, Boston Dynamics, what have you, YouTube, YouTube, yeah. It's also umbrella under the umbrella of Alphabet. And then the next one is actually, I'm supposed to let you guys know last week, but I have been so busy because my knees were having issues, so I have to go through rehab exercises every day and see the doctor. And also my uncle was having mobility issues, so I have to take him to hospital. So I have not been able to let you guys know ahead of time. Why? Because this company had just sold up almost 26% today. It is Vertiv Holdings, VERTIV, Vertiv Holdings. Oh my gosh. I wish I had let you guys know earlier. And let's see if I can find it here. Vertiv. What does it do? Verdi Holdings provides critical digital infrastructure technology for data centers, communication networks, and industrial environments, focusing on power management, thermal management, and rack systems. As a key player in AI infrastructure, Verdi enables high-density computing by offering advanced liquid cooling, power distribution, and monitoring services to keep technology operating without interruption. Thermal management, power management, integrated racks and enclosures, service and support strategic partnerships. OMG, it just shot up 20-something% today. I'm so sorry. I'm kind of late to let you guys know, and I don't have a lot of shares. I only have 100 shares. That's it. I only have 100 shares, and it's not even on this upcoming public account that I will be disclosing in the next few days. I am going to have a new public account so that you guys can just see my progress with the stock that I own in that public account particularly. So I'm not talking about my personal accounts, but my public accounts that I will be putting 20,000 in the account for starter and buy 5 to 15 stocks and let you guys see the progress throughout the years. So the third one was Pure Storage, and then the fourth was Alibaba. The fifth is Verti Holdings. And I will be talking about number 3, number 4, and number 5 in the next video. I'm so sorry, guys. I run out of time and OMG. Wish you guys all the best. Thank you for watching. Oh, by the way, before I go, now, remember last video, for the last video, I say stocks are coming down, that video. Now, this dip is different from the previous dip of last April, 2025. Why? This dip is not a friendly dip. Last April was a very friendly dip to us, to our retail investors. This dip is different. This is an AI, it's AI driven. Now, every company is guilty until proven otherwise. Now, this is the situation that the market is in. AI is going to disrupt a lot of jobs and a lot of industries. Some companies, which now may be making good profit, but in future time, in 5 years, 10 years, they could be totally disrupted by AI and large language models. So now the market is pricing in the worst case scenario. Whenever there is some uncertainty, something new to the market, some disruptive force coming, the market see the uncertainty, they always default to the default setting, which is to price in the worst case scenario for every single company until the company proves itself that it is not going to be disrupted by AI. Okay, so right now it looks like we had a nice bounce for the last couple of days after the crazy fall for the previous 2 weeks. But no, Bitcoin is doing what? It is starting to come down again. Look at Bitcoin. Let's take a look. Let's take a look at Bitcoin. Bitcoin is the leading indicator for stocks. BTC prices. Yeah, see, it is now. It dipped down 2 weeks ago for the last 2 weeks, and then last couple of days it went back up a little from under 65,000 to over 70,000, and now it's dipping down to 67 again. And then this one is more like this one. You see that? Yeah, so don't. But see, I'm not a professional financial advisor, so do not just take my word for it. And nothing is financial advice, and I'm here to share with you my thoughts about the market and the state of market and where things may be headed. if you have better understanding in certain area, I really welcome you to share with the rest of us. We can learn together and we can help each other to grow our portfolio. And I believe in the long run, our company will be proving themselves that they won't be disrupted by AI at all. And actually, they will be taking advantage of the AI wave. Guys, thank you so much and see you in the next video. Ciao, ciao. Have a good, wonderful, wonderful evening.